Welcome back, ICT traders. In the last few episodes, we've explored CISD blocks, breaker blocks, and mitigation blocks. Today, we're diving into another essential concept in ICT, the rejection blocks. These are powerful tools to help you spot potential market reversals and fine-tune your trading strategies. In this video, we'll go over what a rejection block is, the characteristics of a valid rejection block, and we'll analyze them on the chart. If this series of videos proves useful, please like the video to show support, and don't forget to subscribe to the channel for more insightful content to come. Let's get started. What are rejection blocks? Alright, let's keep it simple. A rejection block is basically a buy or sell zone on the chart that shows up as big wicks, or shadows, on candles. These wicks happen when the market tries to push past a certain price level but gets rejected, kind of like the market saying, "Nope, not happening." Rejection blocks usually form around key support or resistance levels, or near major supply and demand zones. They show areas where buyers and sellers are fighting it out, but the market isn't ready to keep moving in one direction. These spots can lead to trend reversals or pullbacks, which is why they're such great opportunities for traders like us. Let's take a look at an example on the chart. One question that many of you ask at the end of most of my videos is about which time frame to use. Guys, rejection blocks and other types of blocks are concepts that you can utilize across various time frames depending on your personality traits and strategy. I usually use the 15-minute time frame to explain examples, but in this case, I've used the monthly chart of the dollar index to show that these concepts work in any time frame. For example, if we look at the monthly USD index chart, we can see an upward trend where the price pulls back into an FVG, fair value gap. In this zone, it creates equal lows, building liquidity for us, so we can assume there's a liquidity sweep happening here. As you can see, once the liquidity was taken, the price shot upward and formed a rejection block. We mark the wick of this candle as our rejection block, and if the price retraces to 50% of this zone, we look for a buy entry. It's an excellent buying opportunity. In a downtrend, the same idea applies to rejection blocks. For example, let's look at the Euro monthly chart. The price has seen a big drop, and we expect it to correct toward a specific order block. When the price reaches this order block, it often tries to lure inexperienced traders into shorting the market with bearish candles. But what usually happens is that, after triggering sellers' stop losses and activating buy orders, the price moves in the opposite direction. This creates a candle with a wick, or shadow, which we can mark as our rejection block. A bearish rejection block forms when the price spikes upward but quickly drops again. This shows that higher prices were rejected and hints at a potential continuation of the downtrend. To identify it, mark the upper wick of this candle as your bearish rejection block. If the price retraces to the 50% level of this block, that's your chance to enter a short trade. Just like with bearish rejection blocks, this area is packed with sell stop loss and sell limit orders. When the price retests this zone, it's a great opportunity for short trades. It's important to understand that not every rejection block you spot on a chart will lead to a successful trade, especially if it appears on its own without a clear structure or context. To trade rejection blocks effectively, they need to align with other market conditions and factors. Through backtesting, we've learned that rejection blocks work best when certain conditions are met, ensuring a valid setup. Here are some key rules to improve the reliability of a rejection block pattern. 1. Rejection block at 9:25 or 9:30 New York time. In my analysis of the rejection block, I noticed that a rejection block formed exactly at 9:25 or 9:30 New York time never has its high or low violated during that time frame. This setup has a lot of similarities to the ICT silver bullet concept. Make sure to backtest this. In this chart of the Dow Jones on the 15-minute time frame, you can see that the candle at 9:30 formed a rejection block for us. The market has been moving in the direction of that rejection block candle until the end of this session. 2. The formation of a rejection block simultaneously on two time frames. The formation of a rejection block simultaneously on two time frames, for example, 5-minute and 1 minute or 15-minute and 1 minute, significantly increases the validity of our rejection block for trading when this happens. In this chart of the Nasdaq on the multi-time frame, you can see that the rejection block formed on 4-hour, 1-hour, 30-minute and 15-minute. It's a valid signal for trade this rejection block. Number 3, SMT or smart money technique. A rejection block is one of the key points where we pay attention to SMT, which is essentially the same as divergence. When SMT aligns with a rejection block, it increases the confidence in our trade entry. For example, here we have the dollar index and euro charts, and you can see how the rejection block combined with SMT has created a beautiful trade setup. Number 4, rejection at a higher time frame key level. As we've mentioned before, a rejection block is a reversal pattern that works best when it happens after the price touches an important zone on a higher time frame. Key levels on higher time frames, like the 4-hour, daily, or weekly charts, have a big impact on price movements. When the price reaches one of these zones and forms a rejection block, it's a strong sign that a reversal might happen at a critical level, making the pattern more reliable. Without this higher time frame confirmation, a rejection block might appear in areas where the market isn't likely to make a significant move, lowering the chances of a successful trade. Number 5, sweeping a liquidity pool. The concept of ICT rejection blocks is based on the principles of institutional order flow and liquidity manipulation. A rejection block occurs when the price sweeps through a significant liquidity level, which is typically found above or below major highs and lows. This action creates long rejection wicks and indicates a shift in market structure. Next, after this liquidity grab or what we call a liquidity sweep, the price reverses sharply, leaving behind a long wick. This wick is your evidence of rejection. Finally, these rejection candles are often referred to as institutional funding candles. The area around them becomes a hotspot for high-probability trading setups. Lastly, Rule number 6 states that rejection blocks are considered for one-time use. This means that the focus should be on the trading opportunity when the price first enters a rejection block. Once a rejection block has been mitigated, it should not be regarded as a significant area for future trading. I've shared everything I know about rejection blocks with you. Of course, it's worth mentioning that for trading a rejection block, it's not necessary for all the conditions mentioned to be present. Depending on your strategy, you can combine 2 or 3 of them. You should also know that gold is very sensitive to rejection blocks and often reacts to them. Personally, I also use Nasdaq and Dow Jones quite a lot. If you found this video helpful, don't forget to hit that like button and subscribe to our channel for more SMC insights. Let us know in the comments what topics you'd like us to cover next. We love hearing from you. Thanks for watching, ICT traders. Until next time, trade smart and stay disciplined.